Imagine a catastrophic financial loss, the kind that usually means a project is dead and buried. Now imagine that exact same project suddenly lights up with the backing of the biggest bank on Wall Street. That's the exact situation we are looking at today. We have a token that has suffered a brutal 99.9% price collapse. But right in the middle of that freefall, the team behind it secured JP Morgan as a client. So we are faced with a very specific question. Are we looking at the market's most severe mispricing, or just a dying asset managing to squeeze out one last major headline? The asset at the center of this contradiction is Biconomy, or BICO. This chart shows the severity of the drop. The price falls sharply from its peak, down to a fraction of a cent. And right as it hits the absolute bottom of that trough, the institutional partnership lands. To figure out if Biconomy has any future, we have to completely ignore retail hype cycles and look strictly at the raw, back-end utility it actually provides. Biconomy is a functional utility token, rather than a digital currency designed for spending. Its technical foundation is built directly on the Ethereum network. It operates without the public-facing interface found in consumer apps or decentralized exchanges. This is Web3 plumbing, the back-end code that other applications rely on to function. This positioning places Biconomy squarely in the B2B enterprise sector. Enterprise software moves through slow, multi-year adoption cycles, which stands in contrast to the viral, fast-moving nature of retail crypto trends. Since users never interact with the tech directly, Biconomy's longevity depends entirely on developers choosing its architecture, making its success a matter of technical integration rather than retail attention. The main barrier keeping everyday users away from Web3 applications is extreme user friction. When a user tries to interact with Ethereum, they are forced to pay a complex network cost known as a gas fee just to execute a basic action. This diagram illustrates the problem. A normal user attempts to connect to an app, but their path is instantly blocked by a solid wall, the gas fee. Biconomy intervenes by acting as an invisible routing layer. Instead of hitting the wall, the connection routes completely around it through the Biconomy architecture. The routing layer absorbs that network cost on behalf of the user, allowing them to reach the application without interruption. In the industry, this process is known as enabling a gasless transaction. This invisible fix lets people interact with blockchain applications without ever needing to know they are using a blockchain. The broader technical architecture that makes these gasless transactions possible is called account abstraction. Account abstraction upgrades standard crypto wallets into automated smart wallets. These smart wallets give developers the ability to create seamless user experiences that span across multiple different blockchain networks simultaneously. Suddenly, data and value can seamlessly flow between completely disconnected networks, treating them like one single environment. This specific capability brings us directly back to the JP Morgan partnership. Traditional finance giants require account abstraction because they cannot expect their legacy clients to manually manage private keys or juggle multi-chain gas fees. Widespread enterprise adoption of Web3 cannot happen without the exact invisible plumbing that Biconomy provides. Now we look past the technology to examine the hard math of the token itself, starting with its $25 million market cap. BICO has a hard-capped total supply of exactly 1 billion tokens. This graphic shows the total supply is effectively full. 1 billion tokens are already 100% circulating. For retail investors, a fully circulating supply means zero risk of venture capitalists unlocking huge batches of tokens and diluting your holdings. However, there is a major structural catch. Biconomy has no deflationary burn mechanism to slowly reduce that massive supply. This creates a strict double-edged sword. You won't face sudden dilution, but the absence of a burn mechanism means the price can only go up if massive organic new demand enters the market. That need for massive new demand becomes obvious when looking at BICO's historical price action and the reality for investors holding from the last cycle. Back in the December 2021 bull run, this token established a massive all-time high of $21.87. Today, that peak sits in sharp contrast to a highly suppressed trading price of roughly 2.5 cents. This chart highlights the technical baseline investors have to watch right now, specifically the 2-cent mark, where the price line is currently bouncing to find support. Market sentiment remains heavily bearish, and the daily trading volume is incredibly thin when you compare it to larger infrastructure projects. So despite securing Tier 1 technology and partnerships, the token is suffering from severe momentum stagnation. That makes holding the 2-cent support line a make-or-break survival zone. The primary trade-off here is clear. Buyers get institutionally validated technical architecture, but they have to accept completely stagnant market momentum. This decision matrix breaks down exactly who should be looking at this asset. If you focus strictly on the underlying infrastructure, the real enterprise partnerships and fully unlocked supply make this a structurally sound project. If you trade on momentum, the lack of retail hype and thin volume means this asset could easily trade completely sideways for years. Ultimately, BICO is a binary bet on Web3 plumbing adoption. It requires extreme patience and is no guaranteed overnight comeback. If this breakdown helped you evaluate the project, hit like and subscribe for more crypto analysis. Remember, this is not financial advice. Always do your own research before deploying capital.